Vinod Karki, Senior VP Equity Research at ICICI Securities, joins us right now on the show. Vinod, it's been a while, but good talking to you today. Thanks for taking the time out. I hope all is well.
All is well, Miraj. How are things at your end?
Very, very well. Thank you so much. And Vinod, I would love to know, how does a strategist like you think of the current phase of the markets that we are in? A very large investor was telling me that the Nifty or the Indian market seem to be like a car which is in a ditch, almost getting out, held back from the rear bumper by a couple of hands, which could be a couple of events, which, if they work out, could make the markets zoom ahead without paying any cognizance to valuations, because it has severely underperformed in the last few quarters. That's a very long summary of what that person told me. Would you concur? Would you think about it differently?
Well, Neeraj, if you see, the expected returns from India, over a longer period of time, how do you, if you measure it in terms of rolling 10-year returns, it is around 13%. And if you do a bottom-up discount rate plus expected return and excess return, it also has been said that Indian equities should get around 13-14% kind of return if you hold for a long period of time, let's say 10-year period. Now, if you see the last 10-year CAGR, it is around 12%. So first of all, it doesn't give me a sense that on a longer term basis, there is some excess in the market overall, because it is actually below the long-term expected return that a country like India should churn out, long term. So from a long-term perspective, that seems to be quite clear. Even from a short-term perspective, last year, if you see from last year, I think we would be, slightly negative right now. So that also doesn't give me a sense that there is excessive optimism overall. But what is happening is there are some pushes and pulls right now, which is kind of impacting the market. Obviously, the biggest one is the US tariff, which is playing on sentiments, I think, more than what it warrants in that sense, because if you do just a simple analysis of the export categories which are getting impacted and the value added from those export categories to the overall economy, it is not that big as the overall environment is making it out to be. And we have seen some sense of improvement on the on negotiations and all. I think that some solution would be coming out. And fortunately or unfortunately, India was never a champion of goods, high-end manufacturing or anything like that globally. So I think to that extent, things are fine, I would say, and there will be some solution to that. So I think from just is there euphoria in the market? I don't think, at least from the headline index level, there could be pockets of euphoria in some areas here and there. So I think, and what has happened over the last 7-8 months is that what one may call as a confluence of 4 or 5 factors, which are kind of which may accelerate the market. In the sense, we had a rate cut, then we had the income tax cut, then the GST cut, all those things. So I think that in a macro model should lead to better growth. I think there are some, already we've seen Fitch upgrade the GDP for India this year. So I think there are reasons to believe that optimism is not high and there are growth levers going ahead.
So Vinod, you speak to global clients as well, right? Are global investors, or at least the ones that you talk to, right, who may be your clients, who may be your connects over the years, are they waiting for the thaw in the India-US tariff issues, or are there some other factors?
So first of all, there are, several things. One, the time and again, when India concerns start cropping up in terms of growth or any kind of uncertainty on the macro front, India valuations come to the fore that, okay, India is so expensive compared to the emerging market, So what I have been observing is that whenever growth concerns come in and then India looks expensive suddenly, The moment the growth concerns go away, then the argument shifts that, okay, we are a better, higher ROE country, growth is better, so we should get that premium. And we have already always got a premium over the emerging markets. That's not, but whenever there are growth concerns like we have today in terms of the tariff and other thing, that creates this confusion for foreigners that, okay, you are the P is expensive, but then growth is also faltering. So how do you play that? So time and again we have seen that bouts of this kind of selling based on the argument that it's expensive and growth is faltering. But if growth starts picking up, I think this argument will not be there that it's so expensive, because India has been expensive all along.
So, Vinod, am I correct in assessing that you believe that growth may pick up? And would that growth be enough for, forget the Nifty, right? Just look at, let's say, a broad universe of the X number of stocks in your coverage universe, that some of those might have fairly strong earnings growth potential over the course of the next 12 months, 18 months? And are some of those pockets of high growth priced attractively?
No, I think, see, if you look at it from a macro model, it's very simple that the amount of stimuluses that the policymakers have done for boosting the domestic economy over the last 6-7 months, it's very simple that in the next 6-7 months, 1 year, it will show in macro demand picking up. And see, what also is important to note that last quarter, when we saw the GDP deflator being low, then that resulted in nominal growth being weaker. In fact, we are doing the number. The nominal GDP of 8 to 9% that we got was actually closer to what the profit growth was for the NSE 500 companies of around 8 to 9%. So, but what we are observing and what the RBI is also forecasting, that by the end of Q1 FY27, while the real demand will increase, the inflation also start picking up. So, moderate amount of inflation with real demand, I think that's the best phase for nominal growth stocks. Stocks which grow on nominal earnings. I think going forward, I think because we have found a base on the inflation, and inflation starts rising along with demand pull from all these factors, I think we should get a decent double-digit nominal profit growth, which should keep the markets and the investors' confidence going ahead.
Is your portfolio tilted towards consumption right now, Vinod? And if so, which facets of consumption?
Well, see, what the global economy has entered into unprecedented time where it's inward-looking policies, be it US or any other country, and this whole environment of bilateral trade agreements. So I think investors don't like uncertainty. So if the rapid phase of globalization has kind of slowed down or is creating uncertainty, I think stocks in those areas will get derated, in my view, in terms of PE multiples, because there will be uncertainty continuously on that front. And the focus will shift towards domestic growth. So when you say domestic growth, it has two levers. One is the investment rate and one is the consumption. What we have been observing is that the consumption has been driven by discretionary consumption all along. And in fact, the essentials share of consumption has been fading as population growth fades and people want to premiumize and all. So I think, and all these stimuluses, be it the GST, income tax cut and interest rate, I think that will give a boost to the consumers who have the propensity to consume, save, invest. So I think the domestic investment related and the capex related and the discretionary consumption, these two areas which will be funded by the financials, these three areas I clearly see growth stimulus. If you start getting GDP upgrades and all, these three areas will show growth surprises.
Got it. Okay. The other bit is, Vinod, and I know you do a lot of work on capex. This week, there was one of your peer sets which came out with a note which said that some of those businesses might be baking in the worst of the capex slowdown, and they might be worth re-looking at from an investment perspective. Is it too early to go long on capex themes? or are you doing the
No,
same as
no.
well?
No, so I think capex, I think the one key element of this whole deglobalization and self-reliance on energy and defense and everything, this is a structural move in my view, and that will result in capacity building exercises across countries, not just India, basically. Every other area like a Eurozone, India, China, I mean, everywhere, the rapid phase of globalization has kind of ended. So it will be all domestic demand driven. So every other country, including India, will focus on creating domestic demand. So which requires a lot of investments to be done in the domestic economy. So I think capex will continue to be a structural theme. Only thing is, at times stocks run ahead of fundamentals and then they correct. But what you have
And
to see is that are we in a structural up move in terms of capex? I think
okay,
that we are.
and you believe that we are. So therefore, is it a good time
Yeah.
to buy into capex themes right now, Vinod?
Absolutely, but you have to ensure that you don't buy stocks which have a PEG of more than extremely high PEG. So if what I mean by that is, suppose something is growing at 15-20% earnings growth, don't pay more than 40, 30, 40 PE to that. So that should be the criteria. You shouldn't be buying stocks at 50, 60, 70, 80 PE and they are growing at 10% earnings growth or something like that. That should be kept in mind, that the
Okay.
growth should be there commensurate with the valuation.
Yeah, I don't know. I mean, I don't know if you're at liberty to talk about your portfolio stance and what falls in the model portfolio, but just trying to understand, would the data center, green energy exposed capital good names fall in the list of companies which are available at a reasonable peg ratio?
I don't think there are enough companies of the I mean, I won't be able to name companies here, but I mean, some of these green companies and all get embedded within the larger the company as some kind of subsidiary or those kind of things. But if there was some play, these areas will definitely continue to grow faster. But I won't be able to name any company or anything like that. But the criteria
Okay.
is very simple. If the growth is good and if they are available at reasonable prices, that's the
Go
place
ahead
to
and
be.
buy it. Okay, fine. Let me
Yeah.
just try and get one final word in, Vinod, and I'm moving tilt completely because you look at macro quite closely as well. The falling rupee, and we've hit record lows today as we speak as well, or yesterday, and kind of today's kind of a bit quiet too. Is it a desirable outcome for exporting businesses which are currently under some glare for growth because of the tariffs? So could it actually be an antidote for the short term, for IT, for some of the others?
Well, see, I think the rupee as such has fundamentally depreciated at 3-4% kind of range annually over long periods of time. And earlier this year, if you see from I think in there was this till February of 25, I think we reached almost 87.5 or something that thereabouts, and then there was a massive rally in the rupee for went to almost 84 from 87.4 or something like that, and now it's reverting back to that 88, 89. And I think what one should look at is it depreciating way above the longer term depreciation rate that Indian rupee has had? I think it is around that 3-4% kind of range. So nothing alarming in that way, and nothing spectacular. And what is accentuating this move is the whole narrative around US tariffs, and so I think there could be some speculative activity also there. Because see, fundamentally, why should the currency depreciate? It is the inflation differential between the two countries. Now, as of now, the US inflation is actually higher than India, and their deficits and all and debt levels are even higher, basically. So fundamentally, I don't see any reason that the rupee should depreciate so sharply. I mean, so I think fundamentally it doesn't give me the comfort that this will continue. Basically, this could mean revert in my view. Once this excessive narrative of US extreme US tariffs and all that starts fading in my view.
Okay, we are so Vinod Karki believing that the rupee may have done its bit. Sure, it could do a bit more, but these are levels from where it could mean revert, which means that some bit of a pull back in the rupee versus the dollar could happen, and the rupee could inch higher towards 88, 87, whatever the numbers may have been. I'm not saying he's predicting that. But Vinod, so good to talk to you about multiple things. And while we didn't want you to talk stocks, but you gave good indications around what people can look at on both on the capex and the consumption side. So really appreciate that. Thank you for joining us.
Thank you, Neeraj. Thank you.